Okay, so Oracle just grew their backlog by roughly the GDP of Argentina in a single quarter, and somehow the market still decided to aggressively sell the stock. Welcome to Earnings Unscripted, I guess. Today is June 10th, 2026, and we are unpacking Oracle, ticker ORCL, and their frankly bizarre fourth quarter results.
Right. Bizarre is probably the perfect word. I mean, they are printing absolute monster numbers here. You have remaining performance obligations jumping over 15% sequentially. That is an $85 billion jump, putting their total backlog at $638 billion.
Which is, I should say right up front, not financial advice, just us thinking out loud. But seriously, $638 billion. It feels like every company on Earth is just handing them blank checks for AI computing power right now.
They literally are. Look, if you break down the top line, total revenue came in at $19.18 billion. That is up almost 12% from last quarter. And the real engine there is cloud infrastructure. IaaS hit $5.78 billion, which is an 18.4% sequential jump. The demand is absolutely not the problem.
Right, except the stock reaction completely disconnected from that demand.
Oh, completely. But you have to look at the setup heading into the print. The stock actually had this incredible run during the quarter itself. It drifted a bit lower in April, but then caught this vertical acceleration in late May. It netted out a near 60% gain just for the 3-month period.
Oh, wow. So up 60% before the call even started?
Exactly. It was priced for perfection. Then the regular session closes around 2:01, the earnings drop, and boom, down 12% in extended hours. It settled near 180. They reported GAAP EPS of $1.45, which is actually up from last quarter, and a rock-solid 32% operating margin, but investors saw the massive capital expenditure roadmap and just panicked.
They blinked hard. And wait, I want to talk about how they are actually making this money now, because it is not just normal software anymore. Did you catch that whole hotel checkout anecdote on the call?
Yeah, the outcome-based pricing model.
It is wild. Instead of just selling a hotel chain standard software where you pay per user, Oracle is rolling out these AI agents. So the software acts as the front desk, upsells the guest on a bigger room or a late checkout, and Oracle just takes a direct percentage of that specific upsell.
That is exactly the pivot. You're moving from software as a service to, AI as a revenue share. They're selling tokens and outputs instead of seats. If their agent screens a job candidate, you pay per screening. If it upsells a suite, they take a cut. It ties their top line directly to the real-world performance of their clients.
Which is a brilliant way to justify these insane cloud prices. But it also means they have to physically build the massive infrastructure to power those agents, which obviously takes us right back to why the market freaked out after hours.
Yeah, the CapEx bill is staggering. They're trying to build gigawatt-level data centers to keep up.
All right, let's get into the details of that construction site.
Right. Well, construction is exactly the right word. I mean, they are targeting $70 billion in capital expenditures for fiscal 27. $70 billion. And they just brought in Hillary Maxon as the new CFO 2 months ago. Talk about walking into a buzzsaw.
Welcome to the executive team, Hillary. Now, please go find $70 billion.
Literally. But here's the trick. This is what the market missed when they skimmed the headline numbers. That massive backlog we talked about, roughly $75 billion of it is prepaid or supplied hardware.
Wait, supplied hardware? You mean the customers are actually bringing their own chips?
Exactly. They literally call it BYOH, bring your own hardware. Customers are either handing Oracle cash upfront to build out the capacity, or they are actually, it's more than that. They are procuring the GPUs themselves and paying Oracle strictly to wrap a data center around them.
So Oracle is basically acting like a highly specialized landlord for AI?
That is a great analogy. It drastically cuts Oracle's net cash outlay, and the demand for that floor space is insane. Look, Oracle had this wave of 35,000 GPUs reach the end of their rental cycle last quarter.
Right, and I assume those customers just renewed immediately.
Only about half did, 49%. But the rest of those GPUs, the ones released back to Oracle, They were completely resold to other businesses in the exact same quarter. They never sat idle. Their global GPU utilization rate is 97.5%.
Jeez, that is almost hard to comprehend. I mean, there is zero dust gathering on these processors.
Zero dust, but housing them is the problem, because a gigawatt data center is not just pouring concrete and plugging in a router. I loved this moment from Clay Magwork on the call. He was so blunt. He said, "Anyone that thinks that these things are easy to operate is very confused. You're not just buying a single rack and putting it into your data hall."
Right. The power requirements alone must be staggering.
Oh, they had to bypass the traditional utility grid for their new New Mexico facility. They are literally powering it entirely with clean energy fuel cells from Bloom Energy, just to get enough juice.
Okay, so if customers are funding a chunk of the hardware up front and demand is literally at 97% utilization, where is the panic coming from? Why sell off a stock that just crowdsourced its own risk?
Because prepayments only stretch so far. Oracle's total cash position actually dropped over 18% this quarter. They are burning cash incredibly fast. And management specifically stated they are not planning any new debt for calendar 2026.
Okay. So if you have a $70 billion build out and you refuse to borrow the money, you have to find it somewhere else.
Correct. And that somewhere else is the equity market. They plan to rely heavily on a $20 billion at-the-market equity program.
Oh, wow. Okay, yes, that explains the drop. That is massive dilution coming right down the pipe.
Exactly. You're diluting the current shareholders to pay for the future AI cloud. It's a mathematical squeeze. I mean, they sold off their strategic chip investments in Ampere Computing. They sold Bloom warrants. They're basically scrounging the couch cushions to avoid debt while keeping the build on schedule.
Selling your strategic chip investments to fund concrete and copper. I mean, it feels like they're running a thermal budget right at the red line, which obviously brings up the next question. If you're diluting shares and spending billions just to build the shell, what happens to the profit margins while we wait for all this infrastructure to actually turn on?
They take a direct hit. I mean, the new CFO, Hilary Maxson, was very upfront about it. She said their fiscal 27 gross margins will step down simply due to the timing of this massive data center ramp-up. You just cannot build out that much physical capacity without absorbing near-term pain.
Right. But they are also promising a light at the end of the tunnel, yeah? She explicitly mentioned that earnings will accelerate in the second half of the year once those actual megawatts come online to fulfill customer demand.
Exactly. And the forward guidance definitely backs up that confidence. They are projecting total cloud revenue to jump between 58 and 64% next quarter alone. That is massive.
Wow. And they reaffirmed that completely insane $90 billion total revenue target for the full year, right? They even bumped up the non-GAAP earnings guide to $8.05. So management is clearly not sweating the cash burn.
No. They view it as a mandatory down payment. But if we step back for a second, this whole transition, going from classic software subscriptions to essentially being an AI landlord charging by the token, it completely alters their risk profile.
Okay, so what is the real blind spot for investors going forward?
The execution timeline. Clay Magoric claimed they have mechanisms to protect margins if supply costs go up. But honestly, if there's any delay in pouring concrete or getting those clean energy fuel cells running down in New Mexico, you're left diluting your shareholders just to hold empty buildings. They are basically pricing in a flawless build-out.
And the market hates pricing in perfection because reality is never flawless. That totally explains the after-hours sell-off. You really cannot afford a single missed project milestone when you're tapping the equity market to buy servers.
Pretty much. Although if they actually pull it off, Oracle controls the foundational floor space for this entire AI cycle.
High-stakes corporate poker. I guess we'll see if the house wins next quarter.
The house usually does.
Fair point. Well, that feels like a good place to close the books on Oracle for today. Next time I check into a hotel, I'm definitely going to be looking out for an AI agent trying to upsell my room.
Do not let them talk you into the expensive suite. Catch you all next time.
Bye, everyone.
If you want these earnings chats to just naturally show up in your feed, you can go ahead and follow the podcast right where you are listening now. And as a quick transparency note, this whole show is an ongoing experiment where we use AI to process those massive SEC filings and actually synthesize the voices you hear us speaking with. So we would honestly love to hear your thoughts or ticker requests over at earningsunscripted@datamadness.ca, or you can just grab the X link down in the show notes.
Thanks for listening, everyone.